All right, today we have a stock analysis of Johnson & Johnson, the largest pharmaceutical company in the world. We're going to break down their revenues, look at their profits and margins, look at the debt and free cash flow, take a look at the balance sheet. Then we're going to get into the economic value added to the business, dividends, and then we'll get into a valuation at the end to give you an idea of what the stock is worth and maybe is this a good investment for your portfolio. So let's get right into it. So number one, let's look at the overall space of the pharmaceutical industry to get an idea of who Johnson & Johnson really is. So number one in the world, Johnson & Johnson at $88.8 billion in revenue. We have a few foreign companies, Chinese and Swiss company. Then we get into Merck & Company, which is 64, Pfizer, which I know you've heard of, at 63 billion, and AbbVie at $56 billion. I just wanted you to get an idea of where Johnson & Johnson is as far as its market that it competes in and where the other players are. So we do have a spread, but not the largest spread that we've seen when it comes to the number 1, 2, and 3 companies in the industry. However, there is a solid spread there. So that's just to give you a background of the industry. Looking at the stock today, right now, trading at about $167 per share, Sunday, August 3rd. Let's go to the all-time chart. So we see that Johnson & Johnson has been a steady company. There has been some times of stagnance there, but we're going to get into how this could still be a good player, even if there are long periods of flatness. So we're going to get into that in a little bit. But overall, positive trend with some normal dips depending on what's going on in the economy. We see a little bit flatness right here, but we'll look at the financials to see if we think that's going to continue or not. Looking at a few stats, we have market cap of about $402 billion. Beta of 0.4. So this stock is not volatile at all. If the market goes up 1 point, this stock will go up 0.4 points. So we understand that to be defensive stock and stocks that sometimes we need in our portfolio, especially when we get older and near retirement. We want stocks that are not volatile at all, that are going to be steady. So PE of 17.9, earnings per share, $9.34. And right now we have a dividend of $5.20. That's about 3%. So let's get into the fundamentals of this business to see if it's a quality business, if we're interested in it, and what this possibly can do for our portfolio. So looking at the revenues over the past 10 years, we have 70 billion going up to 88 billion. And I like to look at how many years did the revenue not grow over the past 10 years. So we have 2015 and 2021 revenue went down. However, we do see that it bounced back within a couple of years, higher than it was before. So the trend is overall positive. We have 1.7% annual growth over the past 5 years on average, 1.9 for the past 10 years. So company is growing, not a lot. So a lot of times when a company is growing like this at a very minimal rate, people run away from it because they don't see a benefit to it. However, there are plenty of companies that may not be growing a lot that are great investments. Johnson & Johnson, I'll just say, as the number 1 player in their space, they have as much market share as they can. Of course, there's competition that they can take over. However, when it comes to this space, when there is new markets and new growth, they are in position to take advantage of that because of their position as the number 1 player. So this growth or minimal growth shouldn't scare you away. Let's break down more of the business and see if this could be a good investment. So again, 2 years where the stock did not, or the revenues did not grow over the past 10 years. Now, looking at gross margins, this is a mature company, so we want to see consistency. We see 69% gross margin percentage, pretty much staying in the 60s, getting to 70, but dropping down a little bit, 69% in last year, 67 trending for the last 12 months. So we do see solid consistency with their gross profit. So gross profit is growing at a slightly higher rate, 2.7 versus 1.7 than the revenues. That means as they are making more money, it's costing them less to run their business. So they're becoming a little bit more efficient as time goes on. We like to see that. However, it is very minimal. It's not very a large spread there. But again, we do see what we expect to see when it comes to consistency with their gross margins. Now, going into their net income, 15.4 billion all the way to 22.6 billion for the last 12 months. So right now they're trending to be a whole lot higher than they were last year. So we do see a little bit less consistency here when it comes to their net income. We see this drop off here, 2017. However, net income ratio is what we want to pay attention to. Mostly it's been positive every year, but just not growing every year. We see 22 to 23. We have some years, outstanding year in 2023 where they're at 41%, 15 and trending at 25. So depending on what's going on with the company, you're going to see this kind of bounce around and not necessarily be on a solid growth rate, as mature companies are going to have some things that they need to pay for, whether it's taxes, whether it's other operational expenses that might drop their net income from year to year, but it's positive every year. Let's go to free cash flow. First, let's look at how many negative years. So we do have 1, 2, 3, and trending to be 4 in the past 12 months, but we have 3 years of negative free cash flow growth. However, it's been positive every year, 15.8 billion, ending at 19.8, their highest 20.1 in the year of 2020. And we see it's dropped down, but starting to come back up, but still haven't gotten back to that 20.1 billion that they experienced in the year 2020. So this is where the cash flow is growing. Again, we're not seeing a ton of growth on average, similar to what we saw on the revenues and the profit side, but we expect this from a very mature company in a mature industry. So let's go on to debt. Let's look at debt compared to free cash flow. We want to know, based on the free cash flow that they're generating, how fast can they pay off their debts? So 2015, $12.8 billion in debt compared to 15.8 in free cash flow. That means they can pay off their debt in 0.8 years, going all the way up to last year, 30.6 billion to 1.5. So we love to see companies stay below 3 years of debt to free cash flow, meaning based on the cash flow they're generating, they can pay off their debt in 3 years or less. Sometimes we look at 5 years or less, depending on the business, but 3 years or less is great. And they have an average of 1.5 over the past 3 years. So they stay in a great leverage position, a strong balance sheet. So we like to see that and expect to see that from a company like this. Now let's get into a dividend real quick. This is why a lot of people would invest in Johnson & Johnson, to take advantage of this dividend. So we have a little bit over 3.1% now in total dividend yield. So that's for people who are purchasing the stock right now, a little bit over 3%. And I like to look at their payout ratio. How much of their free cash flow is being paid out in the dividend right now is just under 60%. So that is not a sign of a company that's going to have super high dividend growth in the future. They'll still have growth, but not necessarily super high dividend growth. You got to understand a few things. That free cash flow wasn't growing a whole lot. However, 59% means there is still some free cash flow that could be available to grow that dividend in the future. So let's look at the past few years to see how they've grown that dividend. We got 4.8, 4.2, 5.31, 6.6 growth, and 4.9. So they are growing the dividend, I'd say at a moderate rate. I think the average for S&P 500 companies is about 5.7%, well ahead of that 3.7% of inflation. So yes, they are outpacing inflation with their dividend, and that's the most benefit we have to receiving a dividend as far as developing some type of income for retirement, but not the highest growth we've seen. So that is great. No, I'd say not great. It's good, but not great. There are other companies who are growing their dividend more aggressively and that are at lower payout ratios, which means there's more of that free cash flow is available to grow that dividend in the future. But these two metrics here are solid and what I would expect to see from this company. So we saw that this company has, over a long period of time, steady stock growth. We see that the revenues are pretty steady. They're not growing a whole lot, but they're steady. We see that the profits are strong, not 100% growing, or I'd say consistent, but there and strong. So here's where a company can add a lot of value to you as a shareholder, even though they're not blowing it out the water when it comes to revenue growth and profit growth. It's the shares outstanding, and this is what we want to see from a business that is this established. We want to see them take some of that free cash flow and pay it down every year. And as you're seeing, It was pretty consistent from 2019 to 2021. Then we see that come down over the past 3 years where they've purchased a significant amount of shares and brought down the share count. And as a company does this, it's the same company with less shares, less shareholders, which means the earnings per share increase, not by business growth, but just simply by a company buying back their shares and reducing the share count. So this is where you can make a lot of money in the stock market because those earnings per share continue to climb up as a company takes down the share count. So we love to see that. Next to economic value added, we want to know, is this company earning a return that's above its cost of capital? Now, when I say cost of capital, I'm talking about the interest on their debt, and I'm talking about the opportunity cost with the capital that's on their books, the capital that they have from either selling shares or running their business and earning a profit. They can put that money into a treasury and pretty much get guaranteed returns. So that's an opportunity cost for that money. So we want to compare the weighted average cost of that capital compared to the returns and see, are they developing economic value by keeping their doors open and running their business. So return on capital, we have 16.3%, the average over the past 5 years. And then we have the cost of capital, 4.2%, creating a spread of 12.8. So on average, this company is growing at an economic value rate of 12.808% over the past 5 years. So this is a solid spread, and we'd like to see that. I believe this is well over the industry average as well. So with all of that said, let's look at evaluation of this company. There are quite a few medicines that have been approved and they believe are going to be approved. So this means their expected growth rate is going to go up to about 5% over the next 5 years. Discount rate of 4.3%, that's their cost of capital that we reviewed recently. And then we have, I expect a terminal value of 18. That means if I were to buy the stock today, I expect to be able to sell this stock at the market cap that is 18 times their free cash flow amount. For reference, right now they're trading at about 20 times free cash flow. And 18 has been their average over the past 25 years. So I believe that is a safe bet to say that I can sell the stock for about 18 times free cash flow. With that said, cash flow at 18.2 billion right now. We have a current share price of 167, intrinsic value, true value of the stock to be about $176. That means you're looking at about a 5.6% upside, which means this stock is pretty much right in the pocket of its fair value. So if you were to buy the stock, you're buying a strong company with some pretty strong prospects in the future compared to its recent history, with a strong dividend, strong growth of that dividend, and a company that's going to hold their position. And typically, as we've seen in the chart, pretty much holds their stock value. So we're not looking at a stock that's going to move around a lot. We're not looking at a stock that's going to be a high grower. It's going to be a solid dividend payer. And I think that's the most value that it can bring to your portfolio as far as people who are looking for stocks that have that income and growth of that dividend. So that's what I think about this stock. For reference, for some people who look at this chart and may not understand, let's just say that this company does not grow at 5%. Let's say this company grows at what it's been growing, and let's say it's going to grow at 1.7%. If that's the case, if they continue to do over the next 5 years what they've done over the past 5 years, as far as cash flow growth, this stock is worth about 155 with a fair value range of 140 to 167. So even with that, it's 171, excuse me. So even with that decrease in the expected growth rate, the stock is pretty much at 167, still within what I would say is that pocket of fair value where you don't have to really worry about overpaying for the stock. You're not getting deep value when you buy it right now, but you're not overpaying, and it is a strong quality business. So that's what we're looking for. We're not necessarily looking for the deepest discounts. If that's the case, there's so many opportunities that we miss only investing in stocks that have super deep discounts. So we want quality companies at fair prices, and that's what Johnson & Johnson is right now. So that wraps up my analysis of Johnson & Johnson. Let me know what you think in the comments, and I hope to see you in the next video.